Given another month of hotter than expected inflation readings, can we expect the Fed's narrative to change at all during today's press conference? We want to bring in Vincent, Reinhart, Dreyfus, and Mellon, a chief economist, former Fed economist as well. Vincent, it's great to have you here. So summing up the recent data prints that we have been getting out, even what we are seeing this morning, what does that tell us just about where we are in the inflation narrative and what we're likely going to hear from Powell just in terms of how sticky prices remain?
What we're likely to hear from Chair Powell is bumpy, and the only question is how many different times will he say that word? Look, the last mile in reducing inflation to the Fed's 2% goal is hard. It's taking longer than they thought, but probably not longer than history would suggest. It takes a while for prices to get back into alignment when they were dislocated so much by the pandemic disruptions and the Fed's mistake in letting inflation get embedded into the system to begin with. Just going to take a while. This time round, we want to remember that the Fed's task is to recalibrate the level of the nominal interest rate to the decline in inflation we've already seen. So it's not another 10th here or another 10th there over the next few months. Inflation's a lot lower now than it was 6 months ago, 12 months ago, 18 months ago. What they're thinking about is what real interest rate, what nominal less inflation rate to set to prolong the expansion, which is kind of getting a little rough on the edges while making that last mile to 2%.
Well, given some of the data that we got in this morning, taking that into account, I'm curious what kind of pivot you think we'll hear from the Fed today from that December pivot away from their previous kind of hawkishness. We know that Jay Powell is likely to have to pivot away from that type of thinking. Do you think that we're going to get a full U-turn? Do you think we're going to get a slight shift away? How big of a pivot do you think we'll see?
The Federal Open Market Committee is a big old oil tanker. It doesn't make sharp turns. The pilot's got to send a signal for what to do in about 3/4 of a mile. So two things about what we'll hear this afternoon. The first is what we know already. They always lean into policy action at the previous meeting because they don't want to surprise us. So we know the funds rate is going to stay unchanged at 5.25%. We also know they're going to make an announcement with regard to the slowing of the runoff of the balance sheet because they warned us at the last meeting and it got very specific in the last set of minutes. So we know what the official communication of the FOMC is. Nothing on rates, slowing on the balance sheet. The interesting question is, how true to that storyline will Chair Powell be at his press conference? As you noted in the clip you showed, Chair Powell's a little more optimistic than the rest of his colleagues. He was really hoping that disinflation was going along a path that would let the committee ease in June. If they were going to ease in June, they have some work to do in this statement because they always warn us of it. They're not going to act in June, so they don't have to do any of that work. But he may leave it on the table. He may be a little bit more optimistic in his press conference. That's the open question.
Vincent, I'm curious just to get your perspective right now, especially when it comes to the consumer, because how do you square the falling confidence, consumer confidence, what we saw in yesterday's print, with the fact that consumer spending, at least overall, we're starting to see some cracks in the consumer, maybe this earnings season, but consumer spending has remained so resilient. What does that tell you?
Big disconnect between surveys and data. And it's not just households, it's firms too. I mean, look at the ISM this morning. But also look at consumer confidence, which is much weaker than you would expect relative to what they're spending at stores and given the unemployment rate and wage growth we've seen. So households and firms are not feeling good about themselves. And I think you suggested earlier on what that's about, and that's about inflation. The ISM, for instance, prices paid really oversamples on oil and other commodity prices. They've firmed up. Firms feel the pain in price setting. Households just go to the grocery store, go to the gas station. They're not happy about their lot. And so it's importantly not made up. It's not an artifact of household and firms' mind. They're paying more than they used to, and a lot of relative prices are out of line. Goods prices are still much higher than the prices of the services they provide, and so they're not feeling good about themselves, and that's a problem going forward. And that's why the little softness around the edges in the JOLTS data, in the employment report, and in the surveys do suggest that the economy is slowing some, which means the Fed will ease. When are they going to ease? Not anytime soon, though.